Hey, good morning, everybody, and welcome to this, excuse me, Wednesday, February 14th, 2024 edition of Trading Places Live at EarningsBeats.com. I'm Tom Boley, Chief Market Strategist here at EarningsBeats, and I'll be with you for the next 30 minutes or so as we prepare for another trading day. First of all, happy Valentine's Day to everybody. It is February 14th, so don't forget that day. Kind of important, I think, to some. Anyhow, enjoy your day there. As far as the market goes, not exactly a love fest yesterday. We saw a lot of selling, but I have to question the veracity of the sellers, and I don't know. I just don't. Call me a perma bull if you want. That's fine. But when we get in these secular bull markets, it takes a lot to get me off of that center piece of being my bull. And yesterday's action didn't do it. I mean, we had a big gap down at the open, and it was a big down day. If you looked at your portfolio and you were heavily long, clearly it was probably not a very good day for you yesterday. But there were a couple of things that just kind of, makes you scratch your head a little bit about the selling. Of course, I've talked a lot about how the market can be manipulated. Market makers control the opening prices. And if you look yesterday, almost all the selling occurred at the opening bell. And that is not distribution, folks. People can't get out on the opening bell. They can't get out at yesterday's close. So once the day opens and you start buying or selling or whatever it is, it's from there. It's from the opening bell that tells you whether we're seeing a lot of intraday buying or a lot of intraday selling. And so I've got some interesting charts that I'll show you in just a bit. But let's go ahead and take a look at the action first, kind of get an overview of what took place yesterday. And then we'll take a look at maybe some of those other charts that were kind of interesting, to say the least. The Dow Jones Industrial Average, first of all, down 524 points. We haven't seen many days like that in 2024. So the Dow down 1.35%. Clearly not a good day. The S&P 500 fell about 69 points. That was almost 1.4%. NASDAQ 100 down almost 1.6%, dropping nearly 300 points, 282 points on the session. Mid caps down 69. That was down almost 2.5%. IWM, which is the ETF tracking the Russell 2000 or the small cap index, that fell $8.35, more than 4%. Another big day. Again, we haven't seen much of that in 2024. Transport's taken a big hit, fallen 2.6%. That was 424 points lower. Then we go across the sectors, and you look at the sectors, two of the three, discretionary and technology. So it looks like, we're getting a sell-off in some of those key aggressive groups. Discretionary down 2%. Then we had energy down about 1%. And technology, not quite sure why I had energy in there, but anyway, technology down 1.7. You can see the leadership to the downside there. Discretionary 1.99, technology 1.70%. So that is, certainly not what we want to see. Although when we do have pullbacks, typically the groups that got you there to the upside are the same ones where you see profit taking. I mean, that's where you're going to have your biggest profits. So it makes sense for those groups to sell off, but they didn't sell off as much as you'd think. Again, I'll point that out in just a minute. Recreational products leading to the downside in terms of industry groups. Actually, there were a couple. I think aluminum down 7%. And there may have been one or two. I think tires was down a huge amount, like 14%. But they're pretty, those indices are rather, I'm trying to think of the right word. There's not a lot of stocks that comprise those individual industry groups. It's really just a couple. So if those stocks have bad days, then the index looks like it's, really bad. But anyway, I ignored those two, tires and aluminum, because they both had really bad days. But if you look beyond that, recreational products as a group took a pretty big tumble yesterday, dropping more than 4%. The industrial suppliers in the industrials dropping even 4% yesterday, going down and actually closing just below the 20-day moving average. And there is a negative divergence here, by the way. So perhaps that 50-day moving average is in store there. Home builders, yesterday with the big inflation report coming out, CPI was much stronger than, well, shouldn't say much stronger than expected, but the core inflation rate did come in at with a rise of 0.4%. Market was expecting 0.3%, and that kept our annual core rate unchanged month over month or year over year. So instead of it dropping to 3.7%, which is what I believe was expected, we stayed at 3.9%. Although we did drop a little bit. If you looked at the, didn't do the rounding, we actually dropped from 3.91 to 3.87. So bottom line is the annual rate of inflation actually did drop yesterday. It just didn't drop as much as what the market was expecting. And as a result, folks still thinking, okay, maybe we need to worry about inflation a little bit. Personally, I don't think so. But hey, at least for one day, let's go along with that narrative, because we saw selling in the bonds, 10-year Treasury yield jumping up above that 420 level and continuing to stay there. We'll take a look at that in just a bit, but it is up a little bit further this morning. That is not good for the market in the short term, and that could be one of the catalysts that maybe morph yesterday's initial move to the downside into something that could be a little bit bigger. Still got a lot to maybe talk about there because the market didn't give up quite that easy yesterday. Again, I'll show you a couple of charts here in just a second. But anyway, home builders dropping 3.9%, which makes sense with rates going up. The 10-year Treasury yield is kind of the barometer for the mortgage rates. And so anytime you see that 10-year Treasury yield going up, I would probably be looking for home builders and home construction stocks to maybe take a little bit of a hit. And that's what we saw yesterday. So that's the kind of the quick summary. But most of what took place was at the opening bell. And one thing that's really important on this chart, if you look at it, even though we had a big down day, take a look at these AD lines. I mean, saw a little bit of a move down in the Dow Jones Industrials. We saw maybe just a tad move. I mean, if maybe even a move back to the upside a little bit in the SPX. NDX was kind of flat. Mid caps actually looked like they went up a little. Small caps pulled back. Just my point here is the AD lines were not bad at all. Look at discretionary, worst performing sector, barely budged to the downside. In fact, I mean, I could argue maybe they had a little bit of a pop. I'd have to look at a closer or a shorter term chart. And industrials, you can kind of see same thing, down at the 20-day moving average, but really not seeing much deterioration in that AD line. But again, hold that thought. We'll get to it in just a second. 10-year Treasury yield. So here we go. We got no economic reports out today, but it's the calm before the storm, because let me read to you what we have tomorrow. So we start off with initial jobless claims, of course, at 8:30 a.m. Also, retail sales coming in at 8:30. Philadelphia Fed Manufacturing Index at 8:30. Empire State Manufacturing Index, 8:30. We got import and export prices, which I don't follow that closely. Industrial production and capacity utilization coming out tomorrow. That's at 9:15, just before the market opens. Business inventories at 10. Housing market index at 10. So all of a sudden, these last, 8 days or so, last week we didn't have much in the way of economic news. This week, not really much other than that CPI report until tomorrow. Tomorrow, we're going to get a lot of economic data out. Don't know which way it's going to go. If it's not good, and we've already started a little bit of a downtrend here, that could be something that could spur another gap down. I have a feeling that this market is going to have a downtrend that's somewhat orchestrated by the market makers. I don't think you're going to see a lot of flat out selling throughout the day. I think the majority of what we see are going to be these gaps and then have some periods of back and forth throughout the trading day. That's what I'm expecting. Now, this morning, I can tell you futures are up. We've got the spider. Let me give you the latest here. First, we'll start with the Dow. Dow up $1, which is roughly about 0.25%. And when I say $1, I'm looking at the diamonds, the DIA, which is the ETF that tracks the Dow Jones. The spider tracking the S&P 500 up 2.25, which is up 0.45%. So not quite 0.5%. Yesterday's down move was only 1.38%, by the way, on the S&P at the close. So here in the pre-market, we're looking at jumping 0.45. If you net them out, we're down less than 1% on the S&P since going back on Monday's close. So we haven't really had a huge sell-off. QQQ, pre-market up 0.55%. And then the IWM, which took the biggest hit yesterday, up 1.23% today, back to 197. I think yesterday's low was maybe 193 or so. We're all the way back to 197 already. Now, this is a gap up. So do we sell off during the day? Because if so, that would be more of a sign of distribution. That would be something that is more meaningful, in my opinion, from a bearish perspective. If you're just getting gap downs and you're not seeing any follow through, that's not, in my opinion, a big sell-off like some would have you believe. But anyway, we are looking to gap up this morning, and we'll see what happens after that occurs. It'd be very interesting if we just go back to all-time highs on the S&P 500. I don't think that's going to happen, but I certainly would not rule it out. You know me, I remain very bullish on the year. I think we're going to go through pockets of weakness. I think this could be starting one of them, but I don't bet against the bull market. I don't short. I don't care if I think the market's going down. I'm not going to short. I'll stay out of leverage. I might build a little cash, you know, depending on how I feel during the day. Looking at some individual positions, I might trim something, thinking I might be able to get in a little cheaper later. But that's how I treat these pullbacks in secular bull market advances. I don't go all in. That's what I do in bear markets. And if you think this is a bear market, feel free. You won't get my support on that one, though. So anyway, that's how we're lining up so far for futures. Things looking pretty good there. 10-year Treasury yield right around 4.31 where we closed yesterday. We'll look at that, or we're looking at that right here. Let me give you a quick update, though, see where we are. Yeah, right now sitting right at 4.31, which is actually down a fraction of a basis point. So not a whole lot of follow through. We were up a little bit just earlier this morning, but right now relatively flat. Crude oil prices up about right about I don't know, 3/5%. We're back above $78 a barrel. And if we pull up the crude oil chart, you can see we're trying to get through this area right now from about 79 to 80. So if you're kind of looking at this maybe as a bottoming formation, maybe even like a bottoming head and shoulder, left shoulder neckline, come down to the head, right side of the neckline, right shoulder. This would be a breakout. If we break out, the measurement on this would be probably another $11, $12 to the upside, which could take us all the way back up to $90, which would be this reaction high that we saw all the way back in October. So there's just a couple things to look for there. But a breakout above $80 a barrel, that would be the highest that we've seen crude oil since back in the beginning of November, really since this whole run began. And I like to follow crude oil because crude oil to me gives me a pretty good sense of global demand. So I don't really look at crude oil prices necessarily as something that we need to drive the US market higher. But I do think it's important if we're talking about global economies and some of the international markets. I do look at crude oil as at least maybe one leading indicator, because if you don't have demand for energy around the world, chances are we're not going to have enough demand to really carry those market indices too much to the upside. So and there's some long-term positive correlation there that supports that theory. It's not just me rambling, by the way. If you pull up correlation and look at the crude oil price versus some of the key international indices, you'll see that there is quite a bit of positive correlation over the years. All right, let's keep moving on. Let's talk about the S&P 500. So here was the day yesterday. First of all, 20-day test. I mean, yesterday we got as low as 49.20. The 20-day moving average is 49.15 and change. So after going above 5,000, I think we got up to almost 5,050. We came down almost 150 points off of that high, probably more like 120, 125 points to test that 20-day moving average. Maybe that's it. I mean, we're gapping up this morning, or it looks like we're going to gap up this morning. Maybe that's it. Maybe that was our pullback. Maybe that was our correction. I don't believe that's the case. I still think we got a lot of historical headwinds to face here over probably the next 6 weeks or so, getting through the second half of the first quarter, where we know historically, we don't know what's going to happen in 2024. We're going to find out together. But we do know from a history perspective that gains in the first half of the first quarter dominate gains in the second half, or potentially even losses in many years. So keep that at least, on the back burner. And that's kind of what I do with seasonality. I just kind of leave it on the back burner. In the back of my mind, I know when the periods are that the market tends to move to the upside. I know when we're entering into periods when I shouldn't be quite so bullish, or maybe I should be lowering my expectations just because history tells me to do so. So it's just an indicator like the PPO, RSI, AD lines, relative strength, sentiment. It's just one more indicator, one more thing that's back there, maybe whispering in my ear a little bit. And when all of them start to line up kind of bearishly, or at least, start to signal caution, that's when you want to kind of hone it in terms of trading, especially on the long side. Taking positions. I'm not saying there aren't positions out there that look good, but maybe lowering the position size, so you're not taking a full risk on the position. Those are things that kind of, are that I think about when I'm trading in a market that I am not quite sure which way we're going to go. So long term, I mean, if I'm talking to somebody, if you're out there saying, well, where do you think the market's going to be at the end of this year, at the end of the next year? Should I be in? I don't want to do this daily stuff, in and out trading, trying to figure out what the market's going to do on a daily or weekly basis. I just want to know, what do you think about the, down the road? And for me, it's bullish. I think we're going higher. I'm not going to get into numbers that I talked about back at Market Vision, but so far, this first quarter's played out almost perfectly, like I talked about. I thought we'd get up close to 5,100 in the first quarter. Got 50.47 or whatever it was. I thought we'd have a pullback in the second half of February to early March. Maybe this is starting. I don't know. We're going to find out. I think we could go down. I wouldn't be shocked to see 4,700. And we're sitting at 49.53. That'd be another 250 points. That could be another 5%. I think that's kind of on the outside. It's not exactly what I'm putting my highest odds on. But in the back of my mind, I think that would still be potentially reasonable. And if you look at the S&P 500, we pull up a weekly chart, look at where the 20-week moving average is, and look during secular bull market advances where we tend to find support. When we have any kind of significant sell-off, and when I say significant, I'm talking about, 5, 6, 7%. When we do those, we tend to find that rising 20-week EMA as support during an uptrend. I believe we're in an uptrend. The first test since that late October rally started, the first test would be a 20-week EMA test, and that's currently at 4699.77, 4,700. Now, by the time we get down there, because the 20-week moving average is continuing to rise, so it might be a little higher than that, but we also just had the all-time high. Remember, we couldn't get through 4,800. I mean, here's that 4,800 level here holding us back. This is the 4,800 level back before the cyclical bear market. So we took all that out on good volume. 4,800 is simple support. I mean, this is price support 101. Broken resistance becomes support. The analogy is like when you're in an elevator, you're on the first floor. You got the ceiling above you. When you get to the second floor, your prior ceiling becomes your floor, and now you got a new ceiling. Well, the only difference is here, when you're in an all-time high, there's no other ceiling. It's the sky's the limit. So you don't know where you might turn, but you do know where the key support levels are. And the first big one, price-wise, on the chart to me is right around 4,800, because that was the level we had to clear right before we went into the cyclical bear market of 2022. So 4,800. And then again, if we go a little bit deeper, maybe that 4,700 becomes a play. Now, am I guaranteeing we're going to go down to 47 or 4,800? No. I'm saying that is the range that I would feel comfortable with and not even give it a second thought, because that's what happens during secular bull market advances. You got to be thinking ahead. You can't wait until the market pulls back and then turn CNBC on and listen to what they have to say. They're going to tell you the sky's falling. Follow the charts, follow the signals that are beneath the chart that you can't really see on the surface. Those are the things you need to pay attention to. And just a healthy dose of perspective. You know, my good friend Dave Keller, I love his work. I think he does a tremendous job. I love getting together with all those folks out at Stock Charts. But I saw Dave talk about a trend line that, his short-term trend line is getting ready potentially to break. And I didn't look at it, but I'm assuming it has something to do either with the low off of October or maybe even more recent, the last 5 or 6 weeks. That trend line cannot continue. That trend to the upside cannot continue. The slope's too steep. I mean, you can't keep going up at this rate for a long period of time. You need to break that. I mean, here, think about this. Here, I'm sure we had a nice trend line in play back in 2020. We broke it. What did that do? Did that take us down to the prior lows? Did that trigger a bear market? Did that do anything really bad? No. It just took us down to a support area, gave the market a break. And then what happened? We ended up going right back up, breaking out again. And now, guess what? Now the trend line changes. Now you have a different sloping. This slope right here, we have gone up over 20%, or well, at the high, we had gone up over 20% in 3.5 months. Do the math. How much do you have to go up in a year at that rate? 70%? How realistic is it for us to think that we're going to keep going up at that rate for a long period of time? It's going to break. That's not bearish, folks. That's just consolidation. It's called taking a break. Do we have to go up every day? Do we have to go up every week or month? No. We could have a 3 or 4 week period where we steadily work our way back to the downside, back down to that 4,700 level. It's very, very possible. So just be careful about making too many assumptions or listening to too many of the talking heads. Follow the charts, keep perspective, and you'll get through this period fine. Again, long term, I see us going higher. Could we go to 4,700 short term? Absolutely. Absolutely. I think 4,800 is probably the more likely, but 4,700 I think is an outlier. And earlier this year, when I was looking at the market, I said maybe we'd go as low as 4,550. I don't see that. That would take us back down almost to the high back in July before we had the correction. I mean, is it possible? Sure, anything's possible. I've had folks say we could go back down to 2,100. That's possible. I would put the percentage chance on it personally at about 0.000001, but it's possible. Could we go back down to the cyclical bear market low, 2022, 3,500? It's possible. Chances of that? Maybe I'll give you a full 1% on it. I don't know. 0.5%, 1%. Again, just my take on the market, the way I view it, and the signals that I have and that I use and that have been really good over the last several years. I just don't see that at all. Again, 4,800 is kind of what I believe we have downside. And then I think we'll be right back at all-time highs again later. If we do have that kind of pullback, I would say a few months out, we're going to be right back at all-time highs. All right, so let's take a look at one other thing here, because I'm going to pull up the spider, which tracks the S&P, and let's take a look at the intraday, because this is where I want you to focus on what happened yesterday and tell me how bearish this day really was. Spider opened at 494.53, which was down, I don't know, $7, $6, $7 at the opening bell. We finished down $6.90. So down, up, big up into the close, and roughly finished almost where we started. So how much selling did we see? The selling was at the opening gap. That's where you lost your money, at the opening gap. Everything else netted out to almost nothing. Spider was down 45 cents from open to close. So if you're looking at the Spider, you're looking at the S&P, and you're looking at the AD line measures where you finish relative to your high and low of the day. It doesn't care about where you were at the end of the day yesterday. All about today's action or that day's action. So we finished kind of in the middle. The high was up near 496. The low was in 490 and change. We finished over 494. The Spider actually saw its AD line go up yesterday. So let me take a look here. There's the AD line on the spider. And let's just break this down and look at it just over a 1 month period. Same chart. And if you look from here to here, look at the AD line. It actually went up just slightly up yesterday because we finished slightly in the upper half of this. When you get a big day where you finish near the top, you'll see a big move to the upside. The volume's the multiplier. And by the way, yesterday's volume was big. So had we finished on the low, we would have seen a big drop in the AD line. Or if we'd rally all the way back up to the high, you'd have seen the AD line breaking to a new high. But we were in the middle. It wasn't a big distribution day. So all the talk about this big sell-off we saw yesterday, somebody brings that up at your Valentine's dinner tonight. You know, maybe your significant other wants to talk about the accumulation distribution line. Let them have it. Right? Let them have it. This was not a big distribution day. This was not, look at the action yesterday. Institutions can't get out on that. There was not really much selling intraday. So again, we went down, but it was an orchestrated down day. And sometimes these pullbacks, that's all they are. I can tell you one thing that pullback did is it saved market makers a ton of premium on their in-the-money calls that they're sitting on the short side of. So some more of that by the end of the week or into the early part of next week would probably be welcome. All right, NDX, not really going to say a whole lot again. We had a hollow candle. We finished above the open. And if we look at the QQQ and go back to that same relative chart, QQQ actually trekked higher yesterday. Look at the intraday, 5-day, 10-minute chart. Here's where we opened, 427.28. We closed at 428.55. We actually went up $1.27 during the trading day. It was all at the opening bell. That to me is different than opening here and seeing big red candles all day long. This is orchestrated. This is manipulation. If you don't believe it, that's fine. I followed the market long enough to know what's a real sell-off and what is nothing more than smoke and mirrors. And yesterday was purely smoke and mirrors. We'll see if we have any kind of follow-through. I would expect some, if we have a pullback, to at least see some selling during the day, but we'll see. IWM did make a huge move to the downside. This one didn't come down, didn't come back as much. You can see we opened at 196.22, finished at 194.61. So we did see some selling net during the day. And honestly, that makes a little bit of sense to me because with inflation coming in higher than expected and with rates breaking out, 10-year treasury yield breaking above that 420 level, that, in my opinion, impacts directly small caps more so than these other indices. And so I'm not surprised that we saw a little bit more what appears to be real selling during the day. But we did even get a nice little finish on the IWM yesterday. But with the IWM opening higher today than the other indices, at least that's what it was going to look like. We'll be able to take a look at that in just a couple minutes. Do we see the sell-off? Do we see more intraday distribution? Because we saw a little bit of that yesterday on the IWM. I mean, if you pull it up and you do that versus the QQQ, you'll see that we had the gap down. We opened here, we closed here. So we did see some relative rotation from the IWM back toward the QQQ during the day, which again is what I would expect with at least this temporary pullback. If we're going to blame it on the CPI, then this story here that's being told kind of supports that thesis. Transports, big move down, still got some levels to the downside. Again, for me, 15.2 is the biggest support area on the transports. Let's watch that closely. In the meantime, we've got the trend line, we got the 50-day moving average, we got these recent lows. And so there's definitely a lot of areas of support on the transports. All right, chart of the day. First of all, for those of you looking for your chart of the day in your email box today, you can blame me. I haven't gotten it out yet. So I did look at a chart that I wanted to show you. I don't know if this will be the chart of the day. I'll try and get this out well, we've got the trading room coming up. I'll try to get it out before the trading room. Don't know if I can, but I'll try. If not, I'll get it out probably early afternoon. So it'll just be a little bit later today. But anyway, Monday, Wednesday, Friday, that's when we normally do our EarningsBeats Digest newsletter. Quick 2-paragraph, 1 chart is all it usually is. And if you would like to become part of that newsletter, it's completely free, no credit card required. You can unsubscribe at any time. Simply go over to earningsbeats.com, scroll down. You'll find this box where you can fill in your name, email address, hit that subscribe button. We'll take care of the rest. Everything is good to go from there. So make sure you check that out. Literally tens of thousands of folks have subscribed to our EarningsBeats Digest. There's no reason not to. You can unsubscribe, like I said, at any time. So if you don't feel like it's helping you, get rid of it. But we do try to make it very educational in nature. So I think you're going to find it something that will help in the way you evaluate the market or maybe in the way you look at trades. But anyway, check that out. We have our live trading room coming up in 30 minutes. If you want to attend our live trading room, kind of go through how I approach the market, the different charts I look at, the different signals and so forth, and then the actual decisions to buy or sell. You want to be in the live trading room. That starts again in 30 minutes. You do need to be a member, but we have a 30-day free trial. So if you click here and you're not already a member, you'll be prompted to join 30 days free. You do have to give us a credit card so we get you set up in our system, but we will remind you at the end of the 30 days. You don't have to say, oh man, I forgot about it and I just got charged and I wasn't going to renew. We're going to let you know when you're about to renew. So you can click here to start that no-cost trial or click here, whatever. But make sure you take advantage. I know a lot of you are new or fairly new to EarningsBeats, maybe following us a little bit here on the live stream. Check out the free newsletter. And then if you just want to kick the tires, I think our guidance is second to none. I really do. And maybe I'm biased, but we got a lot of calls. I can go back and show you. We can prove it. But if you just want guidance through the next 30 days, because I think the next 30 days could be a little volatile, a little bit, definitely a change of pace of what we're used to. But anyway, that would take you for the next 30 days through that period. And you can see whether or not EarningsBeats is a good fit for you. So chart of the day, I just wanted to pull up something and I looked at your dashboard and came up with a stock that, actually, no, I went through the scans. So this was a 52-week low scan that I was looking at. I was just looking at the different stocks and things to look at. First of all, you never want to own a stock that does that. I mean, obviously we all do from time to time, although hopefully if you're breaking down, you have a line in the sand somewhere without riding it from actually almost 170 at the prior day close down to 130. That was a 23% move. If you're in a stock overnight and you get a gap down at 20%, there's not a whole lot you can do. But when you get a gap down like this on massive volume and the selling is like this, you have many opportunities to get out and cut your losses. I don't like that because, first of all, you're opening above all these support levels. And during the day, the volume is telling us that the supply is so great that we can't even hold on to any of these support levels. Complete and total breakdown. But here's a couple keys that should have had you, scratching your head about why you would want to be in this stock to begin with. Number one, AD line. That thing's been going down since back in August. AD line continually going down. What does that mean? That means that over time, what we've been seeing is mostly action where we're closing in the lower half of candle bodies every day, or in the lower half of the entire candlestick. That's how the AD line is weak. Now, that by itself doesn't necessarily mean you have an awful stock, but it's a sign that you should at least be wondering why you're in the stock. The other thing is, and this is the bigger one, relative strength. I mean, this has been going down for months and months and months and months. It's in the travel and tourism group, which has been one of the stronger industry groups. And look at its chart, breaking down to new 52-week lows. And relative to its travel and tourism peers, it's been one of the worst performers. Anytime you have a stock and you see that relative strength line going down, 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 you got to ask yourself, why? Why am I holding this? There have got to be better stocks in the travel and tourism group than the one I'm holding. That's the way you should be looking at that in the market. Anyway, let's take a quick look at the open, see what's happening here. So we got the Dow. It's coming down a little bit from the open. Dow's only up about 0.2%. S&P up 0.5%. NASDAQ up 0.75%. Small cap still hanging on, up over 1% today. We're going to see how everything unfolds during the trading day. So yesterday was the gap down, but the bears really, in my opinion, never got control of the action. Today, we've got a gap up. What happens after the opening bell? To me, that's more important than what's happening at, on the gap. I want to know what's going on throughout the trading day. And so right now, we can't tell that because we're only a few minutes in. The VIX, which yesterday at one point went up over 18, which was a crazy move. This morning on the open, back down to 1449. 3.5 points on the VIX. Poof, gone. This is what happens in a secular bull market. You might get fearful for a little bit, you go up, and then the VIX comes right back down. I would not worry unless we had at least one close and maybe a couple closes on the VIX over 20. Because anytime the VIX is at that level, that's telling me that the nervousness is really growing. And when you've got a lot of nervousness in the market, that's when you can get a lot of these tsunamis to the downside. So I'm always okay with the VIX below 20, above 20. I start to kind of batten down the hatches a little bit. So maybe keep those levels in mind. All right. That's it for me. Again, I'll be back in about 25 minutes for your live trading room. All members, EarningsBeats, welcome to join. If you're not a member, make sure you go in and sign up for that 30-day trial. You'll get the next 5 Wednesdays included in your 30-day trial, so including today. So a great deal right there in and of itself. Have a great day, everybody. We'll be back tomorrow for your next Trading Places Live. Have a great day. Happy trading.